Time now to get you ready for the trading day ahead. Joining us now is Hans Olsen, Chief Investment Officer at Fiduciary Trust Company. And here on set is David Bianco, Chief Investment Officer for the Americas at DWS Group. And I was walking over to the, saw you before you came up here.
That's right.
And I said, and you were in a bad mood. You were dour. Sour look on your face. I said, are you bullish?
Early.
And you said, yeah, it's early. But I said, are you bullish? And you said, no, I'm not. Bullish. And you weren't shy about it.
I said, I'm great, but I'm not bullish.
Yeah, you're great, but you're not. You're good, you're great, and you can sell. That's Dale Carnegie, I think. But David, so I would say, knowing you for all these years, your default position is stocks go up over time. You'd like to be in the stock market. So
right.
So you don't feel that way now, but would you call it sort of a short to intermediate term viewpoint? Is that fair to say?
Stocks go up over time because earnings go up over time, and I don't expect the stock market to make new highs as earnings are not growing, and I don't expect earnings
for how long?
I think we're going to be in flat earnings environment, flat-ish, maybe up a few percent through 2020.
So you would lighten up, you would get defensive, you would sell everything. What would you do?
We are not enthusiastic about equities. I'm in a corrective mood still about the S&P. We're suggesting that investors look to risk-light assets, things like corporate credit, real estate, bond substitutes, utilities type of stocks, where the dividends are safe. And, we believe that this trade conflict it's gone well beyond a trade conflict. This is really about irreconcilable differences between the U.S. and China. And for those who are trying to understand what's happening here and they're looking at the art of the deal, this is really a different book. This is the art of the divorce. The U.S. and China are in the process of separating. I think they're heading toward a divorce. We'll see what the relationship is afterward. It's becoming a real difference in ideology. And so
there's always been that there, as we were just talking about.
But now that they are a superpower in their own right.
Yeah, but the lure of 1.4 billion people allows us to look the other way on a lot of issues, and it will continue
because this has gotten so public, I think everybody's forced to take sides at this point. You're not going to be able to play both sides of the aisle.
The NBA, I'm telling you, the NBA this is an allegory for how far apart we are.
Yeah. It's unbelievable.
Let me ask you, so over the to the end of 2020, the downside on the S&P, do you think it's 2,700, 2,200? Right. How bad could this get in your view?
I think the S&P spends most of its time in a 2,700 to 3,000 range. And if we look to late 2020, past the elections, with Republicans holding on to the administration or at the very least the Senate.
We've been in that range for 2 years or for a while. I mean,
no earnings growth.
But the chance of that happening for the next year and a half is almost, you're going to be wrong there. It's either going to go up above 3,000 or below 2,700. It's going to do one or the other. Don't you think? That's kind of a safe call, but I don't.
It's a long cycle, and a lot of things are more elongated than usual. And what we've got going on is the third intra-cycle slowdown. The last one is 2015, 2016. Yeah. And that was basically a range-bound market. Now, maybe the market breaks new highs really quickly in late 2020, but I think it has a hard time doing that before the election.
Hans, last time we were on, I thought you were finally feeling a little more bullish about things. Where are you? Are you with David on this now, or are you feeling a little bit better?
Well, I think the interest rates falling again are forcing investors to take more risk to get something near the same modicum of return, the quantum of return. So, and I agree that if you look at where the market's been over the last year, we're up only about 2% from last September. So we've marked time for the last 12 months or so, and earnings have pretty much done the same thing. I do think this trade conflict or this trade war, which is sort of redefining this relationship that we have long had with the Chinese since they entered the WTO. I'm not sure if it's a divorce, but it certainly is a renegotiation of the partnership. And the way that we're doing is creating one big unforced error onto the economy that is bleeding into the equity markets. That said, the way that the central bank is inevitably going to respond to this is going to force investors to, I think, be invested if they're going to maintain the purchasing power of their capital, number one. And number two, it's going to force them to have to take more risk in order to get it.